Today is January 31, 2024. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. I'm going to begin with a piece that I did yesterday. I'm going to expand upon it a little bit, which is I always kind of look at risk in the market, in the stock market, and what is the increase of risk and the decreasing of risk. I covered this piece on commercial real estate yesterday, and I want to expand on it. So here's my thought. Commercial real estate is in the process over 2024 and 2025 of collapsing. And that's not an inflammatory word. It's, in my opinion, a true statement. The reason it is collapsing is because of rising interest rates and significant declining of occupancy due to work from home, and the fact that banks are now requiring a much higher down payment or equity in the building for them to finance it. So when you put all three of those together, it spells a lot, in my opinion, a lot of owners. These could be real estate investment trusts, these could be institutions, they're pools of money, they're typically not an individual, actually handing back the keys and saying, I don't think so. I think that will happen a lot. And we have $1.5 trillion of mortgages, commercial real estate coming due. The impact of that on our economy will be significant. It will be felt everywhere. Even though you may not be involved in commercial real estate, it will have an effect because it's going to affect your city and it's going to affect your bank, probably. And a lot of these are regional banks, actually. So I say that to say we need to be aware of this. So this is 2024 and 2025. What is that going to do to the equity market or to the economy? I don't know, but I just don't see it being positive. When you think of I did some research on this and saw that in Dallas, for example, there is 10 million square feet of office space that is unoccupied. In San Francisco, that number is 30 million square feet, and in New York City, it's 100 million. That's a lot of empty offices. So when you start to look at that throughout the economy, the value of those properties coming down, the ability to refinance those at much higher interest rates with higher down payments, I see it being very problematic. And so my view is be very careful for the next couple of years. That's not going to send the market straight down. It's certainly not going to send it straight down tomorrow. I don't think so. But it is a risk factor that is present. It must be dealt with, and the implications are negative for both cities and banks. Okay, now I'm going to go over to the dashboard, and two of them, and show you what's going on. This is as of Friday, last Friday, the 26th of January. You can see that in the pink box, which is what I focus on, which is the year to date. So this will give us the first 3 weeks or so of the market, and you can see that the NASDAQ 100 is up 3.5%, the S&P 500 is up 2.5%, and the Dow Jones Industrials is up a little over 1%. Everything else is negative. Emerging markets, developed markets, small cap, small companies, and of course the worst by far is the 20-year government treasury bond, TLT, down over 5%. There are 11 sectors inside of the S&P 500. Let's just say the S&P 500 is the stock market. And inside of that stock market, there are 11 component parts, 11 sectors, different aspects of the economy, if you will, different types of companies. So when I do the same thing, not the last week is in yellow, so we could cover that, but the thing in the yellow box I think that's notable is that Energy was up 5%, and telecommunication was up over 3%. Those, to me, were most notable. When I look at the year to date, which will get me three weeks or so, I find that the technology was up over 4%. Telecommunication, as I said, was up 4%. Financials were up 2.7. Healthcare up 2.1. Then staples and energy slightly positive. So when I look at all of that, other than technology and telecommunication, a lot of that is defensive. And then you have 5 sectors which are down or negative for the year, and 4 of them are down over 3%. So interesting. When you look to the right, you'll see that there are green dots and red dots, and those that are above the moving averages of the 20, 50, 100, and 200-day moving averages, going from left to right, they get a green dot, and those that are below the moving average get a red dot. So you can see most of them are positive. So there are 44 potential opportunities to go red or green, and there are 36 out of the 44 that are positive. Last week, there were 34. So it's actually slightly more positive than even last week. So when I look at I look at the bottom 4, retail, basic materials, real estate, consumer discretionary, those being the most negative. Yeah, but other than that, you've got a lot of positive going on in the market. Okay, playing off of that thought, the S&P 500, this is SPY, which is the S&P 500, you can see this from, about 15 months ago, back in October of 2022 to present. It's been up and down, but by and large, it has been positive. And so particularly from late November to present, that last move in the market that went up, very positive. So hopefully you were invested during all or most of that time. And if so, you definitely benefited from it. But you've also benefited from the entire year of 2023. So hopefully you were invested. So when I compare in the S&P 500, the growth stocks, SPY-G, to the value stocks in SPY-V, I put SPY-G as the numerator, SPY-V as a denominator, and so if this goes up, it is favoring growth stocks. If it goes down, it's favoring value stocks. It's done both. But when I draw the line from the beginning of 2023 to present, it definitely, again, has done both. But during the last quarter, October, November, December of 2023, you see that decline, that favored value. And the moves before then and the moves after then favored growth. So right now we're in a growth environment. Growth is outperforming value currently. When I take the S&P 500 SPY and I divide it by small cap, the Russell 2000 small cap index ETF, IWM, so it's a ratio showing relative strength just like the previous one. So you see the direction from March to present is, or you could even say February to present, is positive. So what that favors is large cap, large company stocks being stronger than small company stocks by quite a bit. And that's represented by the black arrow. The long-term government bond, TLT, this is a 3.5-year period of time, you can see has declined, including the last month or so. The last month or so, it has been down, and you saw in the dashboards that I pointed out that the TLT, long-term government bond ETF, has been down over 5% year to date. So that is more than countering the gains that have occurred in the S&P 500. So, a 60-40 portfolio, for example, has gone nowhere in 2023. The dollar, now, so you think in terms, okay, we've got countries and economies and markets in those countries. We also have the currency itself. In our country, the currency is the U.S. dollar, and then you have the pound sterling or the euro or the yen or whatever. And so for the dollar, since it's a reserve currency, if it goes up, it means it's going up relative to other currencies. Or we typically are paired against the euro or even the pound sterling. So this is recently, in the last month or so, as you can see that move up at the upper far right, you can see the positive move in an upward direction. That shows the short-term view that the dollar is rallying. When you take an intermediate term view going all the way back to, say, September of 2021, this takes you back a ways, the overall trajectory is represented by the black arrow. So that's positive. So if you are traveling or buying goods from other countries, relative, depending on how their currency is relative to the dollar, you probably, if you're in the U.S., you're probably doing very well. If you're in those countries and buying something from the U.S., you're disadvantaged because your currency is devalued relative to the U.S. dollar. Gold has been in a short-term pullback for the last month or so, and you can see that at the far right of the chart where it declines a little bit. But when you take a more intermediate term view, going back to November of 2022, you can see that the overall, even through the ups and downs, the overall trajectory of gold, represented by the ETF GLD, is in an upward direction. Silver is also up over that time. However, it has not kept pace with gold. So SLV, the ETF for silver, has actually declined since May of 2023. But if you went all the way back to the fall of 2022, you do see that there is an increase in value in silver. When I put silver and gold on a relative strength chart, I would say the trend of this relative strength, so in other words, how is silver doing relative to gold? The silver since beginning of 2023, this takes us back over a year, has been declining relative to how well gold has done. So gold, on an intermediate term basis, gold relative to silver is positive for the last year or so. Bitcoin continues to do well. It's had definitely some ups and downs, and it doesn't seem to me to be correlated to anything. It like gold and silver or energy. It kind of does its own thing. So, but this is the view from November of 2022 to present. Volatility index is down around 13. You see that number at the lower right of your chart. It's been down below 13. It's been down in the 12s and coming down all the way from 32 down to 12. Wow. Even down to 13. Wow. That's volatility index indicates volatility in the market. And so usually if this goes up, it's a sign of increasing risk and usually a decline in the equity markets and vice versa. I put the black line up at 24 because that's my indicator for if this rises above 24, that tends to be periods of higher risk. Asbury Research does indicators. These are 6 indicators, mostly fundamental. And 3 of those, we went from 1 green one last week, now we have 3, and 3 negative, which are on the far right side. So it's mixed, both positive and negative. The Asbury research also does a cross-asset relative performance chart comparing one asset or class of stocks or assets to another. So for example, and I look at all 3, I'm going to give you these, the ones that occur for the last week, the last month, and the last year. That's the last 3 columns, 3 large columns going back in the last week, month, and 3 months. And you can see stocks are outperforming bonds by quite a bit. High beta, high volatility, is stronger than low volatility by quite a bit. Large cap, much more favorable than small cap, quite a bit. Broad market, S&P 500, stronger than the Dow, the blue chips. And that is favoring the S&P 500. And then when we get to bonds, corporate bonds are doing better than government bonds, and high yield bonds are doing better than corporate bonds. Now this is a chart, I think the detail in this is the first time I've ever seen this. This shows that for the time periods of monthly and quarterly, the U.S. has outperformed every market in the world. I'm not talking about the economy, I'm talking about the market. And there is our ETF surrogate for our market is SPY, S&P 500, and you can see in the second column the ETF for each of those countries. When put on a relative strength basis, quarterly and monthly, the U.S. is stronger than all of them. And there are in the weekly category some that are stronger than the U.S. The U.S. is stronger than a few of them. But it's interesting to me that this basically is a chart that favors the U.S. equity market. I thought I would show you I picked one country and I picked France. I showed it last week to show the U.S. market SPY compared to EWQ, which is France, and to show you how well the U.S. market has done relative to France, or you could even say the Eurozone. From May to present, look at the degree of strength in the market. Now, remember, this is not the economy, and this is not the currency. This is the market. Gold and silver. As of last Friday, the 26th of January, gold was at $20.20 an ounce, and that is down 0.1% from the previous week. Silver, however, had a positive gain, and it was up 0.7%, up from the previous week at $22.85. Now that's the spot price to which you add the markup to get the price you would pay if you were to buy silver or gold. The ratio, the gold-silver ratio, is 88:1, which makes silver a better value at these prices. Even though silver is in a little bit of a decline relative to gold, people who follow the gold-silver ratio think at these prices that it favors silver as being a better value. A monster box of silver is at 500 rounds of generic bullion is $12,555. Now that is including the markup. The markup is $2.26 per ounce, and times 500, that makes it $25.11 when you count the spot price, and that makes it $12,555 for a monster box, including the markup. When you go to a tube of 20, not 500, but 20, the cost per round goes up 50 cents per round to 26.11. Okay, thank you for watching. If you have questions or comments, leave them in the comment section below.